to Boni's Life, your weekly dose of clarity in the chaotic world of crypto. I'm your host, Boni, and today we're going on a deep dive, a proper submarine expedition into the murky depths of the crypto market. The past 72 hours have been nothing short of extraordinary, a tug of war between the bulls and the bears that has left many traders scratching their heads and checking their portfolios with a sense of trepidation. So, what's really going on? Is this the calm before the storm, or the storm before the calm? Stick with me, because we're about to dissect the market's every move, from the technical jitters to the global economic tremors that are sending shockwaves through the digital asset space. And trust me, by the end of this episode, you'll have a much clearer picture of where we stand and where we might be heading. We'll be looking at the nitty-gritty of the charts, the fundamental shifts in institutional sentiment, the global events that are pulling the strings, and of course, we'll be hearing from the big guns, the traders, the analysts, and the institutions who are making the billion-dollar bets. We're talking about insights from the likes of Bitwise, Galaxy Digital, Standard Chartered, JP Morgan, Bloomberg, and BlackRock. And as always, I'll do my best to make it all make sense, with a little bit of that intellectual humor you've come to expect. So grab your coffee, settle in, and let's get to the bottom of this great crypto consolidation. Whether you're a seasoned trader or just starting your crypto journey, this episode is packed with actionable intelligence. First, let's zoom out and take a look at the big picture. The total cryptocurrency market capitalization, the grand total of all digital coins and tokens in existence, has been dancing around the $2.4 trillion mark for the past few days. Now, to put that in perspective, that's down from $3.1 trillion just a month ago, a staggering loss of over $700 billion in value. We saw a bit of a dip, a collective holding of breath, as it slid towards 2.3 trillion, but then a plucky rebound on February 15th pushed it back up to 2.47 trillion. With trading volume surging to $100 billion in a single day, it's like watching a high-stakes game of musical chairs, but with trillions of dollars at stake. This tells us the market is in a state of indecision, a consolidation phase where neither the buyers nor the sellers have a clear upper hand. It's a period of sideways movement, a plateau after a steep decline, and it's a crucial time for traders to be paying very close attention. Now, let's talk about the king of crypto, the one and only Bitcoin. Over the past 3 days, Bitcoin has been on a wild ride. On February 14th, Valentine's Day, Bitcoin opened around $68,800 and managed to push up to $69,700. Then, on February 15th, we saw a more aggressive move, with Bitcoin touching $71,000, the highest level in over a week. But by February 16th, the sellers came back with a vengeance, pushing the price down to a low of $67,384. And now, on February 17th, we're sitting at around $68,362, down about 0.74% in the last 24 hours. It's like a mountaineer who has just attempted a new peak and is now catching his breath at a base camp, deciding whether to make another push or retreat to a safer altitude. The key question is, which way does the mountaineer go next? From a technical standpoint, the bears seem to have a slight advantage in the short term, and the charts are telling us a very specific story. The price is struggling to break back above the psychological $70,000 resistance level. According to analysis from Kitco, bears have the firm overall near-term technical advantage. We have a key support level in the $60,000 to $62,000 range, which represents the lows for this year. If Bitcoin breaks below this, we could see a further slide towards the $50,000 level as that Standard Chartered has warned about. On the upside, for the bulls to regain control, we need to see a decisive move back above 70,000 and then a push towards the next resistance zone of $74,000 to $76,000. The 50-day exponential moving average is currently sitting around $80,000 and the 200-day moving average is at $94,000. A break above these levels would signal a strong bullish reversal. But here's the sobering statistic that really puts things in perspective. Bitcoin's current drawdown stands at 47.5% from its all-time high of $126,000 set in October 2025. The recent 7-day decline of 22.2% was worse than 98.9% of all historical 7-day periods in Bitcoin's entire history. Let that sink in for a moment. But here's where it gets really interesting. And this is the part that separates the noise from the signal. While the price action might look a little shaky on the surface, the on-chain data is telling a completely different story. According to the blockchain analysis firm Glassnode, we're seeing consistent buying activity across almost all wallet sizes for the first time since late 2025. And who's leading the charge? The wallets holding between 10 and 100 Bitcoin. These are the serious players, the high net worth individuals and smaller institutions who are seeing this dip as a buying opportunity. They're not panicking, they're accumulating. This is what we call smart money accumulation. And historically, when these wallet cohorts start buying aggressively during a dip, it has often preceded significant price recoveries. This suggests a quiet confidence in the long-term prospects of Bitcoin, a belief that this is just a temporary setback before the next leg up. As the old saying goes in crypto, be fearful when others are greedy, and be greedy when others are fearful. Now let's talk about the elephant in the room, the Bitcoin ETFs. There's been a lot of fear-mongering about ETF outflows, but the data tells a more nuanced story. Over the past 3 months, the iShares Bitcoin Trust, BlackRock's flagship Bitcoin ETF, has seen approximately $2.8 billion in net outflows. That sounds alarming, right? But over the past year, the same ETF has attracted nearly $21 billion in net inflows. The broader spot Bitcoin ETF category shows a similar pattern, with roughly $5.8 billion in outflows over 3 months, but $14.2 billion in net positive inflows over the past year. As Matt Hogan, the CIO of Bitwise Asset Management, explained on CNBC, and I quote, "It's not the ETF investors who are driving the sell-off." He says much of the broader pressure is coming from long-time crypto investors trimming exposure and hedge funds pulling capital when momentum turns negative. The long-term investors, the financial advisors at Wall Street banks who are adding Bitcoin to client portfolios, they are staying put. And that, my friends, is a very important distinction. And it's not just the on-chain data and ETF flows that are pointing to institutional interest. The big players are making moves that could reshape the entire financial landscape. BlackRock, the world's largest asset manager with over $10 trillion under management, recently announced that its Buidel fund, a $2.2 billion tokenized U.S. Treasury fund, will soon be tradable on the Uniswap decentralized exchange. Let me repeat that. BlackRock, the biggest name in traditional finance, is bringing U.S. Treasuries to a decentralized exchange. This is a historic moment. It's the first time a major traditional finance institution has stepped into the world of DeFi in such a significant way. It's a bridge between the old world of finance and the new, and it's a massive vote of confidence in the future of decentralized finance. And there's more. A BlackRock executive recently stated that even a 1% crypto allocation in standard portfolios across Asia could translate into nearly $2 trillion of new inflows into the crypto market. As Sean Stein-Smith from Forbes so eloquently put it, crypto is not collapsing, it's maturing. Now let's turn our attention to the rest of the crypto market, because Bitcoin isn't the only game in town. Ethereum, the queen of crypto and the backbone of the DeFi ecosystem, has been trapped in a consolidation range of its own, hovering below the crucial $2,000 psychological level. It's currently trading at around $1,981, down about 0.85%. The Ethereum chart shows it's been bouncing between 1,800 and 2,100 since the beginning of February, the lowest levels since May of last year. For Ethereum to regain its momentum, it needs to break above the $2,600 level, where its 50-day moving average currently sits, and then push towards the $3,000 zone, where the 200-day EMA provides resistance. XRP, on the other hand, is showing some bearish signs. A pin bar pattern on its Sunday chart, with a very long upper wick and short body, is a classic sell signal. It's currently trading at around $1.49, and we could see a further drop towards the $1.26 level, which represents the flash crash lows from October. And then there's Solana, the high-speed blockchain that has been a favorite of many traders. It's seen a nice little surge of 1.2% in the past 24 hours to $86, but it's still trading at a steep 73% discount from its all-time high of $294. Standard Chartered has recently cut its 2026 price target for Solana to $250, but maintains a bold $2,000 call by 2030. So what's causing all this volatility? Well, it's not just the technicals. There are some major global events that are casting a long shadow over the crypto market, and this is where things get really fascinating. First up, we have the upcoming U.S. Supreme Court ruling on former President Trump's tariffs, imposed using emergency powers under the International Emergency Economic Powers Act. This is a massive deal. The decision, expected on February 20th, just 3 days from now, could inject a huge amount of volatility into every risk asset on the planet, including crypto. According to betting markets, there's a 68% probability that the Supreme Court will rule against Trump's tariffs. When the court delayed a similar ruling back in January, Bitcoin surged by $2,000 in under an hour, and roughly $39 million in short positions were liquidated. Paul Howard, director at Winsent, noted that the more significant catalyst for crypto is likely to be the upcoming U.S. Supreme Court ruling on tariffs. So, all eyes will be on the Supreme Court this Friday. Then there's the recent U.S. government shutdown, which has created a massive cloud of uncertainty over the financial markets. When the government shuts down, regulatory progress stops completely. No crypto bill approvals, no forward movement on the Genius Act stablecoin legislation, no progress on the market structure bill that President Trump himself has said is close to passing. The crypto industry desperately needs regulatory clarity, and a shutdown is the exact opposite of that. And let's not forget the yen carry trade, a complex financial strategy where traders borrow cheaply in Japanese yen to invest in higher-yielding assets like crypto and tech stocks. BCA Research has issued a stark warning, calling this trade a ticking time bomb. The reversal of this trade has already contributed to the crypto sell-off, and if it continues to unwind, it could lead to a flood of selling pressure across all risk assets. As the Forbes analysis pointed out, the growing overlap between crypto, fixed income instruments, and equities means that investors will need to get used to these market sectors moving in tandem. And if that wasn't enough to keep you up at night, we also have the ongoing drama in the world of artificial intelligence. The recent sell-off in AI stocks, triggered in part by the release of a powerful new AI model from the Chinese company DeepSeek, has shown how quickly capital can flow from one sector to another. Microsoft is down nearly 20% in 2026, and Wall Street is rapidly selling stocks of companies vulnerable to AI disruption. Some of that capital has been flowing into crypto, but it could just as easily flow out again. The AI disruption narrative is creating a new dynamic in the markets, where fear of technological obsolescence is driving massive capital reallocation. For crypto, this is a double-edged sword. On one hand, it could benefit from capital fleeing traditional tech stocks. On the other hand, if the broader risk-off sentiment deepens, crypto could get caught in the crossfire. With all this going on, it's no wonder that the experts are divided on what's next for the crypto market, and the range of opinions is truly remarkable. Matt Hogan, the CIO of Bitwise, believes that the recent sell-off is not being driven by long-term ETF investors, but rather by short-term traders and long-time crypto holders who are taking profits. He describes it as a tale of two sides. Mike Novogratz, the CEO of Galaxy Digital, thinks that the era of speculation in crypto may be coming to an end. At CNBC's Digital Finance Forum last week, he said, and I quote, "It's going to be real-world assets with much lower returns. Retail people don't get into crypto because they want to make 11% annualized. They get in because they want to make 30 to 1, 8 to 1, 10 to 1. On the bearish end of the spectrum, Mike McGlone from Bloomberg has reaffirmed his prediction that Bitcoin could drop to as low as $10,000, which he says would signal a US recession. Standard Chartered has cut its year-end Bitcoin forecast by a third, lowering its 2026 target from $150,000 to $100,000, while warning that Bitcoin could slide to $50,000 and Ethereum to $1,400 before any recovery. But amidst all the doom and gloom, there are also some powerful voices of optimism that deserve our attention. JP Morgan has recently turned bullish on crypto in 2026 despite the crash, and BlackRock's strategic moves into the DeFi space are a clear sign that the big institutions are here to stay. Will Rand, the CEO of Granite Shares, acknowledged on CNBC that it's tough to be a Bitcoin investor right now. But he also highlighted an important anomaly. Gold is hitting all-time highs while Bitcoin is crashing. For investors who have supported the digital gold concept, this divergence is unsettling. But it also suggests that when the macro environment stabilizes, Bitcoin could see a significant catch-up rally. And let's not forget the regulatory tailwinds. Two major crypto regulations are expected to drop in the second quarter of 2026, including the stablecoin bill and the market structure legislation. President Trump has confirmed that a full crypto structure bill is close to passing. These regulatory milestones could provide the clarity that the market desperately needs to attract the next wave of institutional capital. So, what does all this mean for you, the individual trader? Well, it means that now is absolutely not the time to be making rash decisions. It's a time for careful analysis, for patience, and for a deep understanding of the market dynamics at play. The next 24 to 72 hours will be crucial, with the Supreme Court tariff ruling on Friday being the single biggest catalyst on the horizon. Here's what I'd be watching. For Bitcoin, the $68,000 level is your immediate battleground. A break below 67,000 could open the door to a test of the 60,000 to 62,000 support zone. On the upside, a clean break above 70,000 with strong volume would be the first sign that the bulls are regaining control. For Ethereum, watch the $2,000 psychological level. A sustained break above 2,100 could signal the start of a recovery towards 2,600. For XRP, the $1.40 level is critical support, and for Solana, $80 is the line in the sand. Keep your position sizes manageable, use stop losses, and don't let fear or greed dictate your decisions. Remember, the best traders are the ones who survive to trade another day. This is a market in transition, a market that is maturing and evolving right before our eyes. The days of easy 100x gains on random altcoins may be fading, but the long-term potential of this technology is still absolutely immense. We're watching the birth of a new financial system, one where traditional finance and decentralized finance are merging in ways that were unimaginable just a few years ago. BlackRock is on Uniswap. JP Morgan is bullish on crypto. Governments around the world are writing legislation to bring crypto into the regulatory fold. The infrastructure is being built, the institutions are arriving, and the technology is advancing at a breathtaking pace. Yes, the short-term price action is painful. Yes, it's tough to watch your portfolio decline. But if you zoom out, if you look at the bigger picture, the trajectory of this industry is unmistakably upward. So stay informed, stay disciplined, and as always, stay curious. That's all the time we have for today on Boni's Life. I hope you found this deep dive into the crypto market helpful and, dare I say, a little bit entertaining. If you did, be sure to hit that like button, subscribe to the channel, and ring that notification bell so you don't miss our next episode. And as always, I'd love to hear your thoughts in the comments below. What do you think is next for the crypto market? Are you a bull or a bear? What's your price target for Bitcoin by the end of 2026? Let me know. And if you found value in this analysis, share it with a friend who needs to hear it. Until next time, I'm Boni, and this is Boni's Life. Stay wise and trade smart.